Mass layoffs and bankruptcies are making headlines, but what do they really mean for your financial future?
George Gammon, along with other experts like Gareth Soloway and Jeff Snyder, are sounding the alarm.
We've cut through the noise to deliver their core warnings in minutes, saving you hours of research.
George Gammon starts by explaining why these layoffs and bankruptcies are a crucial signal for the entire economy. A quick reminder, this is educational content and not financial advice.
Today, we're diving into George Gammon's analysis of the recent wave of mass layoffs and bankruptcies hitting the economy. We'll explore George's insights on why these layoffs are happening and what they might indicate about the future. George Gammon's analysis suggests that recent mass layoffs and bankruptcies are significant warning signs of a weakening economy. According to George, these events indicate a potential shift from a period of economic expansion to one of contraction. George Gammon highlights the decrease in consumer spending as a major factor contributing to the recent economic downturn. According to George, this decline is partly due to rising inflation and decreased purchasing power. George Gammon notes that this trend is particularly evident in discretionary spending, such as dining out and entertainment. George Gammon points to ongoing supply chain disruptions as a significant factor affecting businesses and leading to layoffs. George notes that these disruptions are not just about shortages, but also increased costs, which businesses pass on to consumers. George Gammon explains that some companies are restructuring their supply chains to reduce dependency on single sources, but this takes time and investment. George Gammon emphasizes that rising interest rates are putting pressure on businesses, especially those with high debt levels. George points out that many companies took on significant debt during the low interest rate environment of the past decade, and now they're struggling to repay it. George Gammon suggests that we are likely to see more corporate bankruptcies as a result of these rising rates. George Gammon predicts that mass layoffs will continue in the short term as businesses adjust to changing economic conditions. George suggests that these layoffs will be concentrated in sectors most affected by rising interest rates and declining consumer spending. George Gammon also foresees an increase in bankruptcies, particularly among smaller businesses that lack the resources to weather the economic storm. George mentions that government intervention could potentially mitigate some of these bankruptcies, but the long-term effects of such interventions are uncertain. George Gammon emphasizes the importance of understanding macro trends and their potential impact on individual businesses. George suggests monitoring leading indicators like jobless claims and corporate debt levels to anticipate future economic stress. George Gammon advises being cautious with investments in sectors vulnerable to economic downturns, such as retail and construction. Today, we're breaking down some significant news from the housing market. Zillow has officially downgraded their housing market forecast for 2025. What are behind this revision?
That's right. Given their prominence in the real estate sector, Zillow revised outlook carries weight, suggesting increased caution around future housing market performance.
So let's get straight to it. What's the core message from Zillow's updated forecast?
Essentially, Zillow is signaling a need for more tempered expectations regarding the housing market's performance in 2025 due to recent market behaviors.
What specific indicators does Zillow emphasize to justify this downgrade?
Zillow highlights slowing home sales as a primary concern, indicating a cooling demand in many key markets.
Does Zillow anticipate any actual price declines in the near future?
Zillow's analysis indicates a higher likelihood of price adjustments, especially in overvalued markets.
So what can we learn from Zillow's revised forecast?
Zillow suggests that the housing market is facing increased uncertainty, leading to caution in their projections.
So patience is key for both buyers and sellers.
Exactly. Keeping a close eye on market trends and being prepared to adapt is crucial.
Today, we're breaking down insights from Gareth Soloway, Gareth Soloway, a seasoned market analyst who recently spoke with David Lynn.
Gareth's been calling market tops and bottoms for years, so when he speaks, people listen. His recent analysis suggests more downside is coming. Eek!
The discussion between David Lynn and Gareth focused on critical levels to watch and potential triggers for a significant market correction.
Yeah, And if you thought your portfolio was safe, think again. Gareth believes a major breakdown is on the horizon. Double eek!
Gareth Soloway believes we could see significant downside after market breakdown. Is he really that bearish?
Gareth's analysis focuses on rising treasury yields and bearish technical patterns, painting a grim picture for stocks. It sounds pretty serious.
Okay, so what's driving this negative outlook?
Gareth is concerned about key support levels breaking down, signaling a potential sell-off.
David Lin's discussion with Gareth highlighted the factors that could trigger this downturn.
David and Gareth explored critical technical levels and economic indicators that investors should monitor to anticipate potential market turmoil.
So, we're talking about more than just a minor dip.
According to Gareth, this could be a more significant correction than many are expecting.
Gareth points out key breakdown levels that suggest a significant downside for equity markets. What exactly is he seeing?
Gareth highlights bearish patterns in the S&P 500 and NASDAQ, indicating further declines. He sees a big drop coming if these levels fail to hold.
So, if those levels break, it's time to run for the hills.
Well, maybe not run, but definitely consider taking some chips off the table.
According to Gareth, market structure is looking increasingly fragile. Why is that?
Gareth mentions weakening breadth and declining volume as signs that the market's foundation is shaky. Fewer stocks are participating in the rallies, and trading activity is subdued.
So it's like a house of cards waiting for a breeze.
Pretty much, and the breeze could be anything from bad economic news to a surprise interest rate hike.
Gareth predicts a significant downside if key levels are breached. How low could we go?
Gareth anticipates a pullback of 15 to 25% in equity markets this year if the breakdown occurs. Brace yourselves.
That's a pretty big drop. Should we all be heading for the exits?
Not necessarily, but it's a good idea to reassess your risk tolerance and make sure your portfolio is prepared for a bumpy ride.
Gareth suggests a potential market correction is looming. What factors are contributing to this outlook?
Gareth points to rising treasury yields, slowing economic growth, and persistent inflation as factors that could trigger a correction. A trifecta of trouble.
So it's not just one thing, but a combination of factors.
Exactly. It's like a perfect storm brewing in the markets.
Gareth Soloway recommends watching the 10-year treasury yield closely. What should we look for?
Gareth believes that if it breaks above 4.5%, it's a major sell signal for stocks. Ouch.
Got it. So keep an eye on those bonds.
Exactly. And remember, patience is key. Don't jump the gun based on one day's movement.
David Lin's discussion with Gareth also emphasized the importance of staying informed about global economic trends. So what should the average investor do?
Read up. Gareth suggests following economic data releases and news events to understand potential market catalysts.
Sounds like a part-time job.
It might feel that way, but even a little awareness can make a big difference in protecting your portfolio.
Today, we're diving into the insights of Jeff Snyder, a well-known expert on global monetary systems and the Eurodollar market. Jeff Snyder's central thesis is that the recent yield curve inversion is a significant warning sign for the global economy. Jeff Snyder emphasizes the importance of understanding global monetary conditions, not just domestic ones. Jeff Snyder suggests that if the yield curve remains inverted, the likelihood of a recession increases. Jeff Snyder suggests monitoring the yield curve as a key indicator of future economic conditions. Today, we're diving into a discussion led by Christina Smallhorn on affordable housing options that Wall Street investors might not want you to know about.
Yep, Christina sheds light on how to find affordable housing. Forget bidding wars, we are uncovering the hidden gems in real estate.
Christina uncovers strategies and opportunities that are often overlooked by mainstream investors.
Exactly. It's about thinking outside the box and exploring options beyond traditional single-family homes.
Christina Smallhorn's analysis emphasizes that multifamily homes like duplexes, triplexes, and fourplexes can be a path to affordable housing.
Absolutely. It's about thinking beyond the typical single-family home and exploring options that offer built-in income potential.
Christina notes that these properties allow homeowners to live in one unit while renting out the others, offsetting mortgage costs.
Exactly. It's like having your tenants help you pay your mortgage.
Christina's discussion highlights the importance of local zoning laws and property management in making these investments successful.
Yep, do your homework and be prepared to manage your property effectively, or hire a property manager if that's not your thing.
Christina highlights the cash flow potential. Having tenants can help offset mortgage costs, making homeownership more affordable.
Totally, it's like having someone else help pay your bills, and that's always a win.
According to Christina, you can build equity faster with multifamily properties. As you pay down the mortgage and property values increase, your wealth grows quicker than with a single-family home.
That's right, it's a smart way to leverage your investment and build long-term wealth.
Christina mentions the rising demand for rental properties in urban areas. As more people seek affordable living options, the value of rental units in multifamily homes is likely to increase.
Yep, it's all about supply and demand. And right now, demand for affordable rentals is through the roof.
Christina suggests that with creative financing and renovation, affordable housing projects will become increasingly viable. Think turning old buildings into modern, livable spaces.
Exactly, it's about seeing the potential in what others overlook and turning it into a profitable investment.
Christina Smallhorn points out the potential in purchasing duplexes, triplexes, and fourplexes. They are great for investors and first-time homebuyers alike.
Exactly. It's a way to build equity while also generating income from renters.
Christina Smallhorn emphasized the importance of understanding local zoning laws and property regulations before investing.
Yep, due diligence is key. You don't want to end up with a property you can't legally rent out.
What an enlightening discussion we've had today with some of the brightest minds in finance.
Indeed. Christina Smallhorn, Jeff Snyder, Gareth Soloway, Zillow, and George Gammon each brought unique insights that really enriched our understanding.
It's fascinating that everyone agrees on the significant role of interest rates and systemic issues in shaping our economic landscape.
Right. But the divergence is quite revealing. Christina paints a picture of a prolonged market challenge, while Zillow suggests we might see quicker adjustments.
And let's not forget the inflation debate. George emphasizes its inevitability, but Gareth reminds us that volatility could keep us on our toes.
These contrasting views definitely give us food for thought as we navigate these unpredictable times.
If you found today's insights valuable, give us a thumbs up and don't forget to subscribe.
Yes, your support helps us continue providing these crucial analyses from industry experts.
Stay tuned for our next video, packed with even more insightful discussions. You won't want to miss it.